Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about what Snowflake's fourth quarter teaches public company executives. And it starts with this phenomenon of what I call a SaaS-plotion, where a SaaS, software as a service company, is having a good year, gets to the end of the year, gives guidance on the out year below consensus, and the stock is down 20%. And this typically happens because SaaS companies operate in a vacuum, really only looking at the current year and current periods, not manage the out year. And this sets them up for very poor financial expectations management. So what happened at Snowflake? Well, the company had a good year and an inline year, but it reported guidance below the midpoint of consensus. Revenue for the first quarter of 2025 is about 8% below the midpoint of consensus, and the full year 25 revenue is 11% below the midpoint of consensus. When you report guidance this low, you haven't managed expectations correctly, and you're going to get an extremely negative reset in your stock's valuation. So what is a SaaS-plotion? Again, it's a SaaS company that's having a great year, managing the current quarter, current year, but they haven't managed the out year. They get to the end of the year, they now have to give guidance on that next year, but they haven't managed expectations. The guidance they give is well below the street, and the stock is down greater than 20%. So what are the key learnings of this scenario? The first is when it comes to financial expectations management, there are three variables you have to control: the current quarter, the current year, and fiscal year plus one. Number two, successful earnings is about avoiding extreme negative surprises, such as guidance below the street. And number three, everyone forgets about fiscal year plus one. You need to manage these expectations with generic language by saying, don't run rate everything into the out year. We haven't done budgeting yet. There are a lot of ways to get analysts to be conservative. And remember, a strong IRO doing strong financial expectations management is better than a 37-page earnings deck and the analysts running your consensus. And finally, good financial expectations management means you have control of your valuation. You can't afford to avoid doing this. Thanks for watching. Always here to help you with your capital markets, investor relations, and corporate finance needs.